Hello, welcome to Commodity News on Macro Point of View channel, and today's commodity market news will start with President Xi Jinping from China, who is visiting the Persian Gulf, and he was trying to push some buying of oil without dollar, instead of dollar using directly Chinese yuan. And this value information shows another stronghold of dollar that is under attack, as China already is using their local currency to solve some trade issues and some trade businesses with Australia, with Russia. With Australia, of course, it's both sides will, but with Russia, it's some kind of forced by the sanctions set by United States and the European Union after the invasion on Ukraine, but it also a currency that is used in some smaller countries between for the trades between China and some other smaller countries. If China will be able to push Saudi Arabia or other countries in that Gulf region, they will be able to start pushing off the dollar from the global leader position. Of course, Chinese currency is not big enough yet to be enough to replace dollar, but it might add another brick to the new wall that's separating dollar from the international markets, and that might in time overthrow United States from their leading economical position in the world. And it's not only by gross domestic product, but also by having less important currency than it's now. Dollar is now basic for basic currency for everything, and China is doing what they can to overthrow the king. And now we will see what's going on the markets, on a few markets, and we'll talk about some other news, but this is as very important, but in a very long term information that we already find out. So let's take a look how the markets looks today on a Tuesday. Let's begin with the oil, the Brent oil that is rising from this depth of $75 and is reaching $80. And at the moment there is two factors, and also Bank of America is claiming there's two factors that will have an impact on the Brent oil, on the oil itself, and it's not the sanctions on the price cap on Russian oil. It's only Federal Reserve decision tomorrow on Wednesday 14th about the rates in United States, and second thing is China COVID policy and China recovery on the economic level. With the Fed rates decision, we are mostly expecting 0.5, as most analytics expect that. They don't expect 0.75 points, and 0.25 also is not a good way to expect from FOMC tomorrow. So the rising rates by 0.5 and saying that we will fall down with the rising rates and everything like that, will come down with that might rise the oil, because it will say that United States are not in recession. On Thursday, we've got also decision on European Central Bank about the rates, and Europe is mostly in recession because we've got very expensive energy costs, and that's not gonna change very anytime soon. Actually, the fuel prices are still higher than before the invasion, despite the fact that oil is cheaper, due to the fact that the margins on refinery is still few times higher than last year. Anyway, the China relaxing their zero COVID policy is also a good factor, showing that their demand for fuel might rise again. So the supply of oil dropping by 2 million barrels as a last OPEC cut made in November, and also expectations something between 500,000 and 1 million barrels drop of supply from Russia after the new sanctions entered to the market on this price cap on 5th of December. This is the expectations of the market. That might pump the prices up to even $90. But what I must say that if we cross 85, that will be good way to rise up to $90, but I think we are overreacting. 0.5 is already in prices, and I think something between $75 and $80 per barrel is exact level that market is expecting to have if the Fed will rise by 0.5. If China decided to pump more money and to make it less strict in some cases, not only COVID cases related, but also with some general economical environment, that might pump the price of oil up. If not, I think we might stay under $80 and it will be top level for the next 12 months. Of course, Bank of America expect average price of oil to be around $100 per barrel for the next year. I think it's a bit too much. So we're gonna see how it's gonna end, but this is the current situation. So let's change to some other markets and we'll take a quick look on natural gas, which is rising a lot. We have a huge gap opening on Monday as the weather is supposed to be much colder. On Friday, expectations were saying that this week requirements demand on natural gas in United States, including the export, will be around 121 billion cubic feet per day, and on Monday they rise it to 123.4. Next week, also on Friday, there were expectations about 142 BCFD demand, and on Monday they rise it to 145.8. So that's why we've got this rising market here, and we are on a good way to 7.5, which we should reach before Christmas, or even on the beginning of the next week with hit. We might expect something like this candle here. This candle is at the end of the November. It's 23rd exactly November, so it has a pin reaching $8, and then we might expect some fall if this winter conditions fall back. So as I said, with those news, I expect really to be forecasted 7.5 as a main target, with a pin up to even $8.0 per BTU. So this is what we expect in natural gas, and we can take a look on some other markets. If you read the Macro Point of View website, you probably know that Russian President Vladimir Putin claimed that they might try to avoid the price gap by accepting gold for oil. And with the current prices around 1800 for gold ounce, the oil costing $60 per barrel, it's about 1 gram of gold. The price that was named by President Putin is about 2 grams per barrel, and that might affect the gold market. It won't affect the oil market itself, as it won't be reaching the climax on this one, but it's showing doubling the price of the gold. And it might be calculated by Russian president or his advisors to destabilize a bit the dollar. Because if they will expect the gold in oil will be worth twice as much as worth now, it should rise up to 3,600 per ounce, and that will be very surprising. And if we even on that based pump above $2,500 per ounce, that will be showing that Russia finally finds some leverage against the United States and European Union itself. Of course, it will be mostly be good for Russia itself, as they are one of the main gold suppliers. They also have a huge gold reserve, and it will also affect in positive way the Africa miners. Of course, there is a lot of American companies and European companies and Chinese companies, of course, in Africa, but still it should also be good way for African countries to rise in their value. Yet still the dollar should be really hit hard by this. So in aftermath of rising this gold price, if Russia will start taking gold for oil and this gold price will start rising, the dollar will start falling, we might expect also oil to rising as the dollar will fall. So this is all the connected markets. That's why we can expect quite surprising movements on this market if, and it's a big if, Russia will accept the gold for oil and some countries will start buying oil paying gold instead of dollars, rupees, yuans, reals, or wherever the currency they're using right now. So the gold prices, as we can see, are now hitting above the last top, the last highs, and it's really surprising because it's continuing this rising. You can see that on One News we wrote this, I draw this V-shape here, and we had those V-shape rebounds. Then we are rising here, and we got a drop exactly to the by 23.6%, and we're still rising now. So we are still on a good way, and with the good way of going up, we can expect $1,850. Of course, if there will be no bad surprises from the Fed tomorrow, which means they will not rise by 0.75, or they will say they are becoming very bullish about the rising rates on the next meetings next year. This is, of course, I know it's the moment of ifs, but please remember that it's based on the current situation. I cannot say that will be something for sure, as we've got Fed meeting tomorrow. What's really surprising is that despite the fact we got floods in Australia, and we've got floods and drought in China, we've got drought in Argentina, the wheat prices, the wheat production in most countries rise. We've got some drop on wheat production in Canada. It was drop almost by 1 million tons. It was exactly to be 900,000 tons from the forecasts, and it's a huge drop, but yet Australia reached higher than forecast, and China reached higher than forecast harvesting wheat. That's really surprising. And now Argentina and winter wheat in United States are the main reasons that we should take a look in the point of view of the wheat market, as we've got the very poor conditions on a wheat market in United States. We've got also drought in Argentina, and those two factors are really important things at the moment for the wheat market, and I think that we might expect that this market will be affected. And I'm still very bullish about the wheat prices. I have my own transactions on it, but still I think we can expect to get 900, 950, maybe not in December, as we can not expect the Santa Claus rally. And about the Santa Claus rally, I will wrote an article this week for the macropov.com. Anyway, with this wheat market, I expecting to rise above 900 in January, even above 950. So this is what I see on a wheat market, and at the moment I don't see anything more. We've got export from United States in the week ending on 8th December on a level of over 218,000 tons. I'm not gonna talk too much about many commodities today, as I don't want this show to run forever. I will take a look on the double bottom on coffee. It's really surprising because export in November from Brazil reached 3.4 million bags of green coffee, which is 19% higher than last year. And the Arabica export rise by 25%, and we still have a bounce, a second bounce from this bottom on 154 cents for LBS. And what I can say that we are on a good way to reach 172 or even 73 cents in the next 24 hours. And if we go above it, I think we can then expect to rise up to even 190 cents. And what's good from the coffee is that we have to expect that this deficit, which is expected, it is forecasted for this season, will rise into the surplus next season. And sorry, other way. We are expecting a surplus this season and deficit next. Yeah, I made it right. Sorry for the misleading. We are expecting 2.17 million bags deficit in this season and a surplus 3.24 million bags for the next season. And that's why we cannot expect this price to rise endless. But currently this price at the moment might be affecting because we are still in the season 22-23. So the deficit here will be very important, and the weather in Brazil is very important. We can also expect that there will be some drop of coffee production in Vietnam, about 20%. Yet by this first 11 months in this year, the Vietnam exported almost 1.6 million tons of coffee, which is almost 13% higher than last year. So everything is ahead of us. We have to watch Vietnam and Brazil forecast for this price level, but from the technical point of view, we can now expect a rise to 173, and if we cross it and reach 175 and still cross it, we can expect it even 190, but it will be after the Christmas probably. So, and with those commodity of coffee, I would like to end today's news. I know it's very short, but I would like to keep it shorted and try to realize it maybe twice a week to have it shortened but more accurate, more current news than once a week. Thank you very much for your attention. Don't forget to check the Macro POV website and follow our channel, like the material, and share it with your friends in social media. Thank you very much. Have a good afternoon. Have a good day. Bye.